September 2008. The same storm hit everyone. A 158-year-old bank collapsed overnight. $600 billion vanished. And retirement accounts were erased in a heartbeat. Millions lost their jobs. Millions lost their homes. But in the eye of the storm, not everyone had the same shelter. One door led to foreclosure and bankruptcy. The other? To rescue and bailouts. What if I told you the real cause started with a lie so simple you saw it on billboards everywhere? Why rent when you can own? I remember looking at those headlines back then and thinking it was just a glitch in the system. But the truth is more cynical. The system isn't broken. It's working exactly as intended. For those who own the Jenga tower, not for those of us living ordinary lives. America in 2002 was still reeling from the aftermath of the dot-com crash and the 9/11 attacks that had blindsided the economy. Wall Street was on edge, but the Federal Reserve had a plan. Slash interest rates to basically zero and make money cheap. Suddenly, the American dream was on sale. Congratulations, you're approved for $500,000. But we only make $40,000 a year? Not a problem. House prices always go up. This was the era of the adjustable rate balloon payment, the ninja loan. No income, no job, no assets, no problem. In the early 2000s, home ownership wasn't just a building. It meant stability, status, and suburban desire. The message was pumped through every ad and mortgage seminar. Why rent when you can own? Banks agreed and started throwing money at people like a game where everyone was winning. Then came the subprime mortgage, loans for the unstable, the bad credit, and the undocumented. Bad credit? No credit? You, sir, qualify for a luxury condo. Should I be worried about paying this back? Not your problem. If you default, we just sell the house for more and you still profit. It was a housing gold rush, a national frenzy. Your neighbor's house doubled in value in 6 months. Even a college student working as a dog walker with a negative bank balance could walk out with $1 million mortgage. Just a signature and a dream. The rules were thrown straight out the window. Traditional lending standards were too slow. Risk assessments were too boring. Down payments became optional as people bought houses like bread from a bakery, and lenders printed loans like monopoly money. Mortgage brokers made commissions faster than they could speak, all fueled by a blind faith that housing prices would always go up because they always had. Until now. A question lingered. What could possibly go wrong? Spoiler, everything. By 2005, buying a house wasn't about stability. It was like trading addresses for baseball cards and hoping the next buyer paid double. Real estate was no longer shelter, it was a lottery ticket. People teaching part-time during the day bought houses by night. I just bought my third house with zero down. I don't even live in them. My bank just offered me another penthouse in Miami. This was a national obsession. Buy, profit, repeat. As prices increased, more people rushed in, inflating a balloon to its absolute limit. But beneath the solid surface, the foundations were rotting. Those subprime mortgages were high-risk debt. Yet Wall Street had a brilliant idea. Bundle all that junk together, slap an AAA safety label on it, and sell it to investors as safe. They called them mortgage-backed securities. To make toxic junk look like gold, they hired rating agencies, who were being paid by the banks, to call them safe. Now with 80% more lies. It was like hiring the jury and telling them they wouldn't be paid unless they called your ugly candidate the beauty queen. Then came credit default swaps and CDOs, complex insurance contracts that Wall Street loved, collecting steady fees on something they thought could never fail. Through financial alchemy, garbage loans became investment-grade assets. Yet some skeptics asked a bold question: what if we bet against it? They saw the rot. They marched into Wall Street and said, "These loans are garbage. We want to short them." Wall Street smelled easy money and wrote the insurance, thinking they were pocketing free premiums. They didn't believe the system could collapse, so they built the very thing that would eventually blow up the world economy. It was like buying weather insurance on your neighbor's garden wedding and rooting for a thunderstorm. Every layer was a bigger, riskier bet, while those at the top cheered for record bonuses. Who needs ethics when easy money is flowing? Whistleblowers were ignored, regulators were dozing off, and the people in charge were too rich to care. The party raged on while the floor quietly cracked beneath them. At first, it was a missed mortgage here, a foreclosure there. But then came the wave. Suddenly, the headlines changed. Home prices are falling. They said housing always goes up. They said it was basic economics. For years, the market had been a Jenga tower made of lies, leverage, and wild optimism. In 2007, someone pulled the wrong block. The subprime loans started to implode. The securities built on them were ticking time bombs, and then they exploded. Banks with safe assets realized they were holding radioactive garbage. The AAA-rated bundles were poisonous trash that couldn't be sold. Markets went to zero. Panic spread like wildfire. Investment banks slashed billions in losses until Lehman Brothers, a 158-year-old institution, gone. No bailout, no hero. Just a $600 billion crater in the middle of Wall Street. If Lehman can die, anyone can. Overnight, banks stopped lending. Credit markets froze. The global ATM stopped working. I need a loan to make payroll. Sorry, no liquidity. What do you mean? It means we're closed. Good luck. Families couldn't get mortgages. Businesses couldn't pay workers. Retirees watched their pensions evaporate. 401ks and life savings? Gone. The aftermath was a catastrophe. By late 2008, 8 million jobs were gone and 4 million families were evicted. $19 trillion in wealth vanished. Soup kitchens couldn't keep up with the demand. This was Main Street in free fall, and the crash went far beyond U.S. borders, from London to Tokyo to São Paulo. The entire system was broken. The Great Recession had begun. The U.S. government faced a brutal choice: let the world burn or bail out the guys who lit the match. In October 2008, they chose the bailouts. The Federal Reserve and the government injected a $700 billion pillow through TARP. It wasn't just banks. AIG, GM, and Chrysler all got the golden treatment. Meanwhile, Ben Bernanke was rewriting the rules of economics, slicing interest rates to zero and printing money through quantitative easing. It worked for the markets, but Main Street was still choking. Families who never missed a payment suddenly owed more than their homes were worth. And people were pissed. I just got evicted and they get a bonus? The people who caused the collapse got bailed out. The people who lived through it got pink slips. Wall Street popped champagne. Main Street stood in line for soup. No major Wall Street CEO went to jail. No handcuffs. Just golden parachutes. By 2011, the rage boiled over in Zuccotti Park. Thousands gathered under one sign. We are the 99%. It was about a system rigged to protect the powerful. Privatized profits. Socialized losses. The system survived, but trust burned to the ground. A generation grew up knowing, when the banks mess up, they get rescued. When you mess up, you get wrecked. And here we are today, in 2026, watching the same charts, hearing the same promises, and seeing debt levels that would make a 2008 banker blush. The players have changed, but the human appetite for free money remains the most dangerous constant in history. As you watch the market soar today, just remember, a balloon is at its biggest and most beautiful exactly 1 second before it pops. The only question is, who's holding the needle this time? Because if 2008 taught us anything, it's that the next crisis doesn't look like the last one. It looks harmless, profitable, inevitable, until it isn't. The cycle is repeating, but this time you know the signs. Subscribe to stay ahead of the curve and hit the like button if you're ready for what's coming. This is Finance Cycles. See you in the next one.